Bloomberg Audio Studios.
Podcasts, radio, news.
Hello, it's Merryn Somerset Webb here. A reminder, I will be at the Fringe Festival in Edinburgh once again this year, hosting 4 full days of riveting conversations in Adam Smith's Panmure House. I'll be there from August the 17th to August the 20th. Tickets are now on sale. They are going fast. Of course they're going fast. They'll be sold out quickly. Links will be in the show notes, but you can also just head to the main Fringe website and search for Merryn. There you'll see the availability and you can buy tickets. Hurry. Plus more information about this amazing venue and what we will be discussing. Right, on to this week's show. My guest is Liad Meidar, founder and managing partner of Gatemore Capital Management. We talk about why he thinks the cost of capital is the key issue facing UK equities and why he thinks the great British buyout is going to save the equity market. But first, as always, senior reporter and author of the Money Distilled newsletter, John Stepek is here with me. John, hello.
Hello, Merryn.
Okay, so I'm going to preface this conversation by saying to our listeners, this sounds boring. But there's something John and I are going to talk about, and it's not boring. It's incredibly important. Well, you could say it is boring and important, boring but important, but I think it's not boring and also very important. John, it's important, right?
Yeah, and it's actually pretty interesting once you get into the guts of it, because it's all about pensions.
Okay, now everyone's turned off. Everyone's moved on to another podcast.
Stop!
Pensions are not boring. Pensions are very interesting. And this is a key issue that has been affecting the pensions market, been affecting the balance sheets of big UK companies and being affecting the UK equity market for decades now, right? And it's coming to an end. John, tell us about it.
Well, this is the news that defined benefit pension schemes, so the ones, private sector ones run by companies, ones that you can't be a member of anymore, unless I think you work for Croda, which is one FTSE 250 company, which still has a defined benefit pension scheme. Could be wrong about that, I'll double check, but I'm
Parents,
pretty sure
have your
it's true.
kids apply there.
Exactly.
See if they've got an apprenticeship scheme or an intern scheme or a graduate scheme. Do anything for a DB.
I've already checked. No, so these funds, right up, people kept talking about how there's a pensions black hole, massively in deficit for years and years and years. Now that interest rates have gone up, thanks obviously to Liz Truss, they're now in surplus.
John,
because
you have to stop doing that.
I know, sorry, I can't help myself.
By the way, not Liz's fault.
So interest rates went up, and that means that basically the future liabilities, so the money that they owe the pensioners in the future, that number is big when interest rates are at 0%. And as interest rates go up, that number gets smaller. So it means you need less money in the pot today to pay off your pensioners tomorrow. It's probably the easiest way to think about it. And that's why those schemes are now in surplus.
Okay, let's just go back to when they were in deficit. Everyone's going, oh my God, all these British companies, they've got these huge deficits, poor old pensioners, everyone has to put more money in. So constant pressure on the companies to take big chunks of what would be profits and slew them off into their pension funds to pay for pensions far into the future. Right? It's a big drag on profitability.
Yeah, because it's
at
actual
UK
real
companies.
money.
Real money. Because
the future liabilities, and I guess this is important to understand as well, is obviously a number in the future is uncertain. So it's based on a theoretical value, but the theoretical value translates into something you need to take actual practical action on today. So you need to fill that deficit, and it has to come from real cash that's coming into the company at that point. So yeah, absolutely, as you're saying, it's been a massive drag on money that could have been invested elsewhere or paid out to employees and wages, etc., etc.
I remember writing a column a little while ago, like distraction alert, showing that wages at companies with big pension deficits rose at a slower rate than companies without them. So it had genuine real-world effects, not just on profitability, but on the earnings of people working for these companies. So big deal across the board, right?
Yeah, absolutely huge. And what is interesting, actually, because the first time I wrote about this, because they're now recorded a record surplus in May, but obviously the surplus came about earlier in the year. And there was one FTSE 250 company I noticed, I think it was Coates, that had actually been able to basically stop topping up its defined benefit pension scheme. And its share price went up on that news. So this is something that's a real world right now, absolute, this is really important and it has an effect.
Yeah, and we did write, didn't we? Quite a long time ago, we wrote a couple of columns saying when interest rates go up, buy companies that have theoretical pension deficits because their share prices will go up. And look, we were right.
Basically, right? We were. We told you so.
We told you so. Anyway.
So it matters for the individual companies, but there's also a bigger effect. So one of the reasons that UK capital markets or UK equity markets specifically have had this kind of drag on them for so long isn't just all of the stuff that's happened kind of like recent years. It's also because the rules around pensions got tightened up so much. What it basically meant was that defined benefit pension schemes run by companies shifted all of their money out of equities into bonds, and they also shifted their equity allocation out of UK equities. At one point, it was something, they probably had too much in UK equities at one point, like something like 70%. Now it's down to 3%. So the amount of UK equities held by defined benefit pension funds has collapsed, and that has been a constant drag of outflows for years and years and years. Now, the point being about the fact they've got a surplus now is that this is now fixed, so they don't have to change their portfolio allocation anymore. And B, when it's already down at 3%, there is no, there's no further drag.
Yeah,
it's kind of exhausted. So that big sort of structural selling force is now gone. And even that just vanishing doesn't need to be replaced.
Well, the removal of a negative is effectively a positive, isn't it, when it comes to equity flows?
But then on top of that, you've got a positive coming in. Well, hey, because you're obviously wondering now, well, what happened when all these defined benefit pension schemes closed and of course they got replaced with defined contribution schemes? Defined contribution schemes are the ones where you save the money and the pot is what you get at the end, and what's in it is your problem, basically.
And if you are in an auto-enrolment scheme, which if you're in work in the UK, you almost certainly are, that's what you have.
Yes, so you got an auto-enrolment pension. So what's happening now is companies aren't putting money into the defined benefit schemes anymore, or not as much, and they are putting increasing amounts of money into the auto-enrolment schemes. And the other interesting thing is that in the year to May, the amount of money going into the auto-enrolment schemes overtook the amount of money going into DB schemes. And actually, I was quite surprised. This is the first time that's happened. So again, that sort of shows you just what a drag the DB schemes have been, because it's mostly because companies, like the amount of money going into the auto-enrolment schemes went up at roughly the same rate. It's been going up for years. The DB money collapsed because they don't need to put it in anymore. And the fact that you've got this turnaround now, so basically you don't have to mess around with your DB scheme anymore, and ever increasing amounts of money are going into the auto-enrolment, and that means that some of that money will be an inflow for UK markets, if you like. So yeah, you've got one structural headwind has been removed and a structural tailwind is coming up, to use jargon.
There you go. It's all about the flows.
All about the flows.
Okay, so this is all very positive for the UK market.
Yeah, it should be.
Yeah. and for anyone with a DB pension, which looks like it's going to keep being paid out. John, thank you. And I think, amazingly, that was not boring at all. It was absolutely fascinating. And by the way, everyone, it is very important. Pensions are important and interesting. Welcome to Merryn Talks Money, the podcast in which people who know the markets explain the markets. I'm Merryn Somerset Webb. Here's my conversation with Liad Meidar, founder and managing partner of Gatemore Capital Management. Liad, thank you so much for joining us today. I really appreciate it.
Thank you for having me.
Now, listen, you and I are on the same page with a couple of things here, right? We both firmly believe that the UK market is grotesquely undervalued and has been for some time. But I think your thoughts around why that is and why it might change are slightly different to some other people in the market. So talk me through that.
Sure. Well, I think a lot of the commentary and regulators and people in the city are looking for answers in the wrong places. And in many ways, they're looking for new regulation in ways of, in a sense, manipulating the market to try to get, whether it's retail investors and institutional investors, to buy more UK equities. I mean, I fundamentally believe that UK equities need to stand on their own right and compete on their own right globally for capital. And I think the answers to that really lie in deregulation in many ways, not adding new layers of regulation. I think the extent that people have been exploring opportunities to deregulate, it's around listing requirements and things that are really incremental and around the edges. Good ideas, many of them, but I just don't think are going to really solve the fundamental problem.
Okay, so what is the fundamental problem? What is the problem here? We've got great
The
companies.
fundamental problem.
UK economy isn't that awful. Nothing is that bad here. I may have a little bit of political instability, but goodness me, look over to France, right? I mean, it's not so bad, right? Companies are good. Economy looks okay. What is the problem?
Well, there are some long-term challenges for the UK economy around productivity, but that is not the core driver of the gap in valuation. The bottom line is that the core issue is, at the end of the day, twofold. One is to do with the takeover code, and the second is to do with how board members are incentivized. I think that if you look at the difference, the fundamental difference between UK equity markets and the US, those I think are the two that really have the biggest weight in terms of driving the valuation gap. So starting really with the second point around director incentives, this is something that we've been very vocal about. In fact, we published a public letter for a company recently that really highlighted this point. In the US, when you join the board of directors, you're expected to go into your pocket and buy somewhere between 3 to 5 times your annual fees in the stock. And whether you do that up front or over the course of your tenure, that's the expectation. And people indeed do that. In the UK, you have nothing like that. The expectation is minimal. You see directors buying very little stock. And in fact, the UK governance code discourages companies from incentivizing directors with equity. And so what you have is a situation where there's this concept in the UK of independence, where the real term for it is disinterested. These are not just independent directors; these are disinterested directors. And so when it's time to explore situations like acquisition, selling the business, that's real work for directors. And at the end of that work, they lose their roles. They lose the fees associated with their directorship, and there's very little upside for them. And so really there's a fundamental lack of alignment between directors and shareholders.
Okay, interesting. So you're talking about the general board of directors, but if we look at say, CEO pay,
yes.
Are you including that in this as well? That our
less
CEOs are not incentivized
so.
in the same way? And because we talk about this a lot, and you say, well, what difference should the pay of a CEO make to valuations?
Less so. I think CEOs more often will have equity incentives. But generally, what I would say is that the UK market's now got a reputation for underpaying CEOs, and it makes it harder to attract the top talent. So I think as a result of that, you actually have a situation where we have, a less talented pool of CEOs running UK listed companies. And yeah, that drives some of the valuation gap itself as well.
Interesting. So one of the fixes for the UK, which is not a quick fix, obviously, but you think could be a longer term fix, is to align not just executive management, but all directors, executive and non-executive, with shareholder interest by effectively forcing them into some kind of equity holding or awarding.
Yes,
I
think non-executive directors should be owning a lot more stock in the UK than they do. And I think if you look at the numbers, U.S. directors tend to own many multiples of stock in the company compared to UK directors. And there is a fundamentally different notion of governance, of what is good governance between the two markets. In the US, having that alignment is deemed good governance, appropriate governance. In the UK, there's kind of this idea that like serving on a corporate board is like some kind of noble pursuit, like working for a nonprofit or something like that. And it's the farthest thing from the truth. I mean, shareholder primacy still exists. It needs to exist for an equity market to function well. And, the directors are there to make sure that they can maximize shareholder value. And I think that they need to be aligned with shareholders. I mean, I can't tell you how many situations we've seen where shareholders are extraordinarily frustrated at directors. And it just seems like the board is ignoring the demands. And, when you think about the setup, it's very clear why, because at the end of the day, the sale of the business or selling a division or moving a listing from the UK to the US means they're losing their roles. And they're not interested in that.
And it's an awful lot of work as well. It's interesting. I mean, I do quite a lot in the investment trust industry. And this is one area where there's often a conversation about the extent to which directors should or shouldn't hold stakes in the investment trust. And in the main, directors do. It's expected when you go on a board that you buy some equity. And there's a report that comes out every year, Skin in the Game, which lists the directors of every investment trust and lists how much they own. But more recently, there's been a conversation about the extent that you can expect new directors to buy significant equity stakes if you're also looking for a diverse board of directors, if you're looking for younger people or people who haven't necessarily had many board roles before who aren't in a position to buy. So that's one of the conflicts around expecting directors to make a financial contribution on being employed.
That's understood and needs to be taken into consideration, but it's not to say that only affluent people should be serving on boards, but there's a very easy accommodation, which includes allowing them to buy the stock over time over the course of their tenure. So it's effectively rolling your fees into the stock, and if you are part of the team and you're one of the key decision makers from a governance perspective, you should be very aligned with the shareholders, and you should have skin in the game.
Okay, interesting. So the fact that people don't have skin in the game is one of the things that might put a spanner in the works of your idea that the Great British Buyout is the answer to the valuation problem in the UK. So as I understand it, your thought is that the M&A in the UK is not a bad thing. We shouldn't be saying, oh my God, woe is me, we're losing all our companies, they're disappearing. We should be saying, this is absolutely brilliant. Other people want our companies, and this is going to force up valuations, bring new listings into the equation, everything will be absolutely fine. Thank you very much to the market.
Absolutely. I mean, it's a question of why are companies looking to move their listing to the US? Why are companies not looking to, why is, London not a competitive venue for new listings? It's very simply because of the cost of capital, because, issuers are saying, look, it's too expensive for me to issue equity in London. I have very little liquidity. Why do I want to be there? The way that gets fixed is by putting the UK markets back on a virtuous path. And that virtuous path involves today kind of a shock therapy of sorts. And the shock therapy can't come in the form of new regulation to force, retail investors and to really kind of try to manipulate institutional and retail investors to buy equities. That shock is allowing private equity capital into the markets. And effectively, when you're looking at deals that are getting done, they're being done today at 30, 40, 50% premiums. And the path that we're on right now is a slow bleed out. Over the last 2 years, the biggest buyer on margin of UK equities were corporates, i.e. share buybacks. We are effectively liquidating the UK market slowly over a long period of time. Our view is very simple, which is that what you do want to welcome is kind of a shock to the system, which is a large and aggressive wave of take privates that will all be done inevitably at significant premiums. And what that's going to do is severalfold. One is it's going to retrain, it's going to bring back kind of the animal spirits in the market. So if you even look at domestic investors that have kind of lost faith in the ability to unlock value in the market, for them to see these waves of takeouts, all of a sudden they start to think, okay, well, if I buy a stock, somebody might take it out, the value might correct. And so it becomes an interesting game again. Two is you have foreign buyers doing something similar, saying, UK's looked very cheap. Here's finally a mechanism to unlock the value. And so you have foreign buyers come into the game. And then finally, and importantly, is you very quickly realign the supply demand imbalance. If you have 1,700 companies today in the UK and 100 go away very quickly, you still have a large number of companies on the market. But importantly, what you've done is you've shocked the system and you are realigning the supply and demand. And all the institutional investors, particularly the long-only funds that were sitting on these positions, they all of a sudden get a significant return of capital. And what do they do with that capital? They go back and buy other shares in that same market. UK domestic investors are going to recycle the capital that they get from the sale into new names. And what that's going to do is all of a sudden put us on that virtuous path where there is a re-rating across the board. And with that re-rating is going to come the demand for new listings. And it's going to also slow down the number of companies moving from the UK to the US. And it's going to slow down the number of private equity takeouts because private equity wants to buy cheap. And so we don't, ultimately, as public equity investors, we don't want the UK market to be cheap. And so we believe that that needs to be welcomed rather than viewed as a real negative.
I suppose that the worry here is not to be negative about this, because I love the story. I want to go with the story. But our pension funds are big public investors of that type, who have gradually shifted all their, or a very large part of their AUM out of the UK. I remember it wasn't that long ago that most of the UK's big pension funds had 40% plus in UK equities. Now they're down to 3, 4, 5%. The wealth managers have been moving out and still are. There's still wealth managers who are in the process of cutting that down from 40%, 30% to 5, 6%. And you keep hearing about this flow of money. That is still going. And every time we look at the flows and you think, surely it's got to be positive by now, it never is. That money is still leaving. That is a juggernaut to turn around. The idea that the big pension funds, I mean, you use the words suddenly, quickly, sharp, etc., to turn that juggernaut of flows around would seem to be more a 10, 15-year process.
Yeah, first of all, I don't think the UK pension funds are really in the game anymore. I think they've reduced their equity holdings across the board. A lot of them have significantly de-risked. I would not rely on that pocket of capital really for the future of UK equity markets. But let's just take a step back for a second. 15, 20 years ago, if you look at a UK institutional portfolio, a pension portfolio, or an insurance portfolio, you would find, or nonprofit, or whatever it is, you would find a vast overweighting to UK equities, what we call a home bias. Why? At the time, the UK had about 5% of the global market cap, and yet you would find portfolios with 40, 50, 60% UK equities. Why? The UK needs to compete globally. We cannot look inside and just say, okay, what new pockets of assets internally can we source? The UK should be a global financial center that really is attractive for global investors, and needs to look and compete globally, not just for UK share of the UK wallet.
Okay, I feel like you're not that keen on the Brit ISA.
No, I don't think that's a bad idea. I just think it's incremental. I think that could work. I just don't know if it's going to work in time. It doesn't make the UK more competitive globally. I think that the way you make the UK more competitive globally is you fix the alignment, first of all, between directors and shareholders. And the second point, which I was starting to make earlier, is around the UK the UK takeover code, which I think is no longer fit for purpose. The UK takeover code is like sacrosanct in the city, and people don't want to even debate it. But it's no longer fit for purpose. There are things that make that effectively create barriers for takeovers in the UK that are unnecessary and unhelpful, and effectively take agency away from shareholders, and that's not positive.
Will you give me a couple of examples of the kind of thing that's in the code that?
Yeah, I mean, a lot of things. Sure, the put up or shut up rule. I know that's something that's very unique to the UK. So when a buyer comes in, if you think about a foreign buyer comes and says, hey, there's a company in the UK that we're interested in, we want to approach them. They sit with their lawyers, and the first thing they do is they get a rundown of, okay, well, you have to be aware of a few things. One is, if your conversation leaks, forget a bid. If your conversation leaks, then you have 28 days to put up a fully funded bid, or you have to so-called shut up. You have to stay away for 6 months. And you have to deal with the public repercussions of the fact that everybody knows about this, et cetera. And so that is the kind of thing that's just not particularly helpful in attracting foreign capital. Another example is you need to have a fully funded deal, when you're making an offer. That is a very difficult position to put a buyer into. Now, some buyers can do that if they're making a reasonably small acquisition relative to their size, but you're asking other buyers to not just show the equity capital, but have it fully financed. So in other words, get the debt providers on board, do all of the work in advance, not knowing that you're actually going to get a transaction consummated. That's a big ask. Whereas, in the US, there's a little bit more of a fluid process. It's not as rigid. You can come to agreement. The board can take a view that, this company should be able to get its debt financing. We kind of believe in that. And we're willing to, to get a higher price. We're willing to take a little bit of that risk. In the UK, it's just not even possible. The board can't kind of make that decision. And so the takeover codes really run its course, but it needs to be revisited. And I think barriers need to come down, and they need to come down not just in order to make it easier to transact, but also to signal to foreign buyers that the UK is open for business. Hey, come look over here. We are heading the right direction here with regulation, and I just think that needs to happen.
Interesting. I mean, a lot of people would say, and a big part of the commentariat in the UK would say that it's too easy to take over UK companies. It's too easy to come in, snap up a UK company and effectively take it abroad.
Yeah, I
Not
don't
the other
presume
way
those aren't
around.
people who have bought companies in the UK.
Okay, fair enough. I mean, it is interesting. There have been books written about how easy it is to buy companies in the UK and how we effectively give away our companies.
There is a real issue with a lot of pundits that speak without knowledge or experience. In fact, a lot of our regulators, a lot of people who are involved in regulation, it's just shocking kind of the concepts that they come up with and and what they think is the right solution. And so you see it time and again, and people have views, but you have to really understand what's the driver of those views.
You say that a change in the takeover code would be a really great signal to the world that we are open for business. And one thing that we've talked about a lot on this podcast is that another great signal would be to not have one of the highest stamp duties in the world. And that cutting stamp duty at least down somewhere roughly in the region of where other countries have it, if they have it at all, or abolishing it, would be a great way to signal to the world that we are open for business.
Absolutely. I mean, I think that's 100% a step that should be taken. I think liquidity in the market is very poor. And I think that is for sure both a substantive and important signal change.
Okay, so we got to dump stamp duty, we got to fix the takeover code, and we've got to change the obligations on directors. Anything else?
Those are the core points. And I think that generally, I think the attitude towards private capital, should change. These are not national treasures that are being taken private. These companies that are being taken private often remain in the UK, very often are very well run. And I think at the end of the day, the sooner we let it in, the sooner we kind of deregulate and welcome transactions and create better alignment with directors. The sooner we do that, the sooner that valuation gap closes, and the sooner you have a slowdown of a wave of buyouts. And then the sooner you have companies really vying to list in the UK again. And that would be a good place to be.
Yeah. Is there a case also for changing some of the regulations around listing? I mean, it's very onerous to be a listed company in the UK relative to being a private company. And you hear a lot of complaints from listed companies, particularly smaller listed companies who don't have the resources to have huge compliance and legal departments, that in fact that the burden of this is huge. I mean, I spoke to a recently retired CEO of a company the other day who'd been a CEO of a UK listed company for a long time. And he said in the early parts of his career as the CEO, he was spending maybe 1 or 2 days a year dealing with regulatory issues, discussing things with governments, dealing, lobbying, etc. Towards the end of his career, he could say that was maybe 1 or 2 days a week.
I think deregulating across the board is helpful. I think that signaling, sentiment matters, and I think that when you inject, when you provide the signal that the UK is open for business, that the UK is deregulating, then I think the sentiment that can really drive a shift in sentiment, and sentiment matters.
I want to talk about how you invest, the kind of companies you look for and the way you are a very activist and impactful investor. But before we get to that, I just want to pick up on something that you said at the very beginning when you said the UK does have a worse productivity problem than other countries. Do you have a sense of why that is, or feeling about why it is, and what might change it? You can be rude. It's fine.
No. I mean, I think that it's not really about being rude, but just knowing what I know and knowing what I don't know. It is a bit perplexing on some levels, but I do think that the problem has been around for a long time. Mm-hmm. And I think it's been masked by having an economy that was so heavily reliant on financial services, where productivity became extraordinarily high, and it kind of masked the poor productivity in other elements of the market. And so as the economies become less reliant on financial services, I think that reveals a fundamentally low productivity market. I think the issues when it comes to productivity, I think there's many things at play. And I think that the vast swing in immigration in the UK, both, the kind of exodus from Brexit and then, new forms of immigration makes the data, just a lot harder to interpret.
So let's go on to how you invest. I mean, there's a special opportunities fund, and the idea there is to, summarizing very quickly, find value traps and stop them being value traps.
Yeah, that's fair. I mean, I wouldn't say find value traps as much as we're activist investors, meaning we engage with management board, shareholders to unlock value. The companies, our starting point are really companies that have lost a significant amount of their peak market share. That could involve companies on the verge of distress, which involve significant turnarounds, or companies that really just have lost their footing a bit and need the shareholders to push the board to take certain action. And so we find our role to be really identifying those opportunities, aligning, getting kind of some kind of unity amongst the shareholders around these issues, and just really holding the board to account. And that's what we do.
What's the biggest mistake, do you think, that company management make in the UK and smaller companies? What do they do that causes them to get themselves into these problems?
But that's a whole nother podcast. But where do we start? Because of the nature of the kinds of companies that we look at, the sets of mistakes are a little bit different from, I would say, the broader market. Being a public company CEO or any CEO for that matter, any leader in a sense, the key attribute of a successful leader is being transparent about the challenges and the issues. And I think that once you are transparent and open about where the challenges are, where the mistakes have been, and you own those, you build trust amongst your management team, amongst your board, amongst your shareholders. And, there are very few problems that can't be solved over some reasonable period of time. But when you don't own those, when you try to kind of hide the mistakes, when you try to brush over them, that's when the bigger problems come up. Too many CEOs are too quick to try to kind of hide the mistakes or try to deny that a mistake has been made or that there's a meaningful challenge. They think they need to create a certain appearance at all times, and that's where trust breaks down. And you sometimes see these companies with stock prices that make no sense. And when you really spend more time on it, you just realize the shareholders just don't trust management anymore. That's a problem that's hard to solve. And in fact, most often there's only one solution for that.
Which is for the CEO to go.
Yeah, absolutely.
Okay. All right. So if the core problem with a smaller company in trouble is that trust is broken down, how does an active investor like you coming in, buying a stake, how do you then build trust with a management team who are already not trusted by their other shareholders?
How do we build trust?
Yeah.
Well, we have a saying internally, which is we seek to understand before we seek to be understood. And so, I do think that when we enter a position, we have a thesis, we have a view on what's potentially going wrong. And usually that view is more often than not right. We do enough homework that we really get we build a pretty good mosaic. Having said that, as you get to know the management team, as you spend more time with them, you need to be open-minded that we don't know it all, and there could be factors there that we're unaware of. And so I think that not just being open-minded, but showing management teams our ability to be open-minded and our ability to change our view, I think is important. And from a trust perspective, we're not out to get them. And in fact, I would say more often than not, we play a very supportive role with existing management teams. But the ones where we don't are the ones which make more of the headlines. And so, that's the nature of the beast.
You wrote a public letter recently about Elementis. So that's something that you hold in the fund. So tell us a little bit about that.
Elementis is a company that has underperformed over a long period of time and has significantly underperformed during the tenure of the current management team. They made an acquisition which has not panned out as planned. In fact, I'd say it was a very poor result. And, and the management has not met its targets, but in fact has fallen far short of its targets. And so, I would actually say that's an example of a company where shareholders have lost trust with the management team, and we're expecting the board to make the appropriate changes.
And what are those appropriate changes?
Well, we've highlighted in the letter one of the points we made, which is a topic we just spoke about, which is the lack of alignment between the non-executive directors and the shareholders. Non-exec directors own less than 1 year of their fees in stock. And so, the change is that the company is undergoing a significant cost savings program right now, and is implementing a significant cost savings program. And in the midst of that, we just think that it's not great for company morale to be implementing cost savings while you have a management team that has consistently underperformed keeping their jobs.
Yeah, well, maybe they're listening. Listeners, we'll put a link to that letter in the show notes so you can go and have a look at it and learn more about this in general. Right, a few more things. You are very, very active. Are you concerned that the rise of passive across the world when it comes to investing is a problem for markets, or is it just a huge opportunity for you?
There's two things that have really changed the fundamentals of markets. One is the rise of passive, the other is the rise of quantitative trading. In both of those cases, the investors aren't looking at the fundamentals, and so that leaves a more limited universe of investors who are still looking at the fundamentals. Now, one would argue that there are enough active investors out there to set, the prices appropriately. For someone like us, it creates opportunity. I mean, for our biggest concern is buying the right way, because we fundamentally view if we buy right and we can get what we want to get done, the valuation will play out, accordingly. And so there's an important role for passive investing in the investment universe, but I think people need to be reminded that passive only works because there are active investors out there.
Yeah. And so there may well come a tipping point when there is too much passive.
What's going to happen is just active investors, by definition, should over time be able to capitalize on that. It's just going to require a different kind of capital base, where investors maybe aren't providing, funds aren't providing daily liquidity, but maybe have a longer term view on their capital and can hold positions and really significantly outperform markets as a result of that. Now, having said all that, I mean, part of the story here is that the vast majority of wealth creation in the markets has been some of the bigger tech names out there, and that's been in recent years. That's a part of the equation that kind of needs to be taken into account as well.
Yeah. And the other big change, along with the rise of passive, we've also had the rise of private equity, which is something that you're quite close to because you're working in the sort of private equity style end of the market, right? And one of the worries with private equity is that it's not necessarily particularly good for companies. They get their costs cut too much, they get loaded up with debt, etc. And it's not necessarily the best thing for a company. So if we get to a stage where we see less private equity, more IPO, that seems like a good thing, a good shift back of the pendulum. Do you think?
If we're seeing less private equity and more IPOs, that's because valuations have corrected. Having said that, I don't think that there's anything inherently wrong with private equity owning businesses. In fact, I think that private equity more often than not runs businesses well and is able to do things and invest in the business in ways that sometimes companies as standalone independent public companies can't. And so I think that there are some advantages to being held as a private company versus a public company. And in some cases, it can be in fact better.
So the rise of private equity might even be about something other than cheap debt.
Yes, as the cost of debt has risen, I think that's going to separate those private equity firms that are creating real value versus the ones that made their money entirely through financial engineering. But I think there are definitely many private equity firms that are the real deal and are good stewards of that capital. Competing
with you a bit though?
No, not competing. We welcome private equity into the public markets, and in fact, I think we need to see more of it right now.
Yeah. In essence, let's end on a positive high note. in essence, you're pretty bullish on the UK. So all the things that people will look at and might say, well, it's perfectly fair for the UK to be cheap because it's, their companies are badly managed, lousy productivity, political risk, shooting themselves in the foot with net zero and overregulation, etc. All those things are not minor, but not going to hold us back from possibly seeing a good re-rating. So we should all probably run out and buy the FTSE 250 or even smaller.
I don't know if I'd say I'm bullish broadly about UK markets. I think there's a lot of value in individual names in the UK market.
Okay.
And I think there is a path towards unlocking that value. And I think that boards really need to think very carefully about how to unlock that value.
Excellent activist answer. Thank you.
That's what we do.
That's what you do. The final question, and the one that I have to ask everybody on this podcast, and mostly I know which way people are going to go, but I don't know which way you're going to go on this one. If I gave you the choice over a 10-year period of holding one asset and one asset only, and I made you pick between gold and Bitcoin, which would you choose?
Well, it's never Bitcoin. So whatever the other option is, and I know that's a predictable answer in many ways.
No, it wasn't predictable. Most people don't say never Bitcoin. So tell me why never Bitcoin. We get a lot of, well, I don't really know enough about Bitcoin, so I'm going gold.
Bitcoin.
You've been very clear. So I'd love to hear a little more about that.
Bitcoin is a speculative asset that, has no basis to trade one way or another. In my mind. It really has no intrinsic value. By the way, gold doesn't either, but at least gold's been around for thousands of years, and at one point, was the underlier of some major global currencies. And so, I just think Bitcoin. It's really interesting when you hear these evangelists talk about Bitcoin and talk about fiat currencies, and you look at the U.S. dollar. Americans spend $5.5 trillion a year on U.S. taxes. Until the IRS starts accepting something other than the U.S. dollar as payment, the U.S. dollar isn't going anywhere. I mean, it is the all this idea that the U.S. dollar has no fundamental value. Well, it underlies the world's biggest economy. Now, I think from there, you can look at currency by currency and try to think about, what's the fundamental value in currencies. But Bitcoin certainly just doesn't belong in the conversation. It's not a real asset. It looks like a real asset in some ways, but it's fundamentally not.
If I were to be incredibly generous, because it's you, and this has been a really great conversation, and say to you that it didn't have to be Bitcoin or gold, you could choose one other asset class to hold for a decade, what would that be?
Equities. That'd be easy.
UK equities, global equities, nice Vanguard ETF.
I think the easy decision is owning SPX, owning the S&P 500. Global equities would be a close second.
Liad, thank you so much. Absolutely brilliant. Really nice to
enjoy
talk to
the conversation.
Thanks for listening to this week's Merryn Talks Money. We will be back next week. In the meantime, if you like our show, rate, review and subscribe wherever you listen to podcasts. And keep sending your questions or comments to merrynmoney@bloomberg.net. This episode was hosted by me, Merryn Somerset Webb. It was produced by Sama Sadi and Moses Andam. Special thanks to Liad Meidar.